Hey, everybody, Jake and Gino here. And today we're talking about what we are buying, our current apartment buying strategy. Gino, the market is constantly changing, and that's why we always recommend to all Jake and Gino community members, you got to have multiple tools in your tool belt to take deals down. This gives you the ability to take deals down in any market cycle, and you got to keep momentum going. It's all about creating that cash flow snowball. Inflation is also raging, and investors are trying to understand where the ceiling is. Look, when you know your rental rates, you know what your comps are in your area, you're an expert on your market. This is the most important factor to determining what you're going to be able to pay for a deal. It's plain and simple. This deep knowledge is going to better equip you to make competitive offers and stand out. So, Mr. G Daddy, we're busy right now. We got 7 deals closing in quarter one. One of those being a refi, to be fair. But what are we buying and why?
Let's take a little step back into memory lane. Our very first deal, Jake and Gino were just buying, didn't know what our exit strategy was. Before you buy a deal, be clear on how you're going to exit that deal. Because as our coach Bill Ham says, wheels up, that plane's in the air. Once you sign that doc, that plane's in the air. You've got to land it, whether it's a refi, whether it's a sale, or whether you're going to give it off to a family member, whatever that looks like. So think about what the exit strategy is. And it's very, very important. Hit me up, Creative Cash, Gino at jakeandgino.com. I will send you a PDF copy of Creative Cash. Why Creative Cash? Because it really starts discussing about our proprietary 3 pillars of real estate. And it's really important to look at the 3 pillars of real estate and couple that with the buy right, manage right, finance right. The 3 pillars of real estate basically talks about the market cycle, which Jake is talking about, the debt and the exit strategy. Once you know your exit strategy or you can understand it, you have to look at where we are in the market cycle. When Jake and I first started, it was a buyer's market. I mean, brokers had deals on LoopNet for years. There was no money. So we had the upper hand as buyers. We were buying assets at really great prices. We were able to buy them, put significant CapEx into them, and either flip them or refi them and hold them long-term. Things have changed in 2022 if you haven't been around for the last 7 or 8 years. You know, people have been talking about the market being at a high point since 2018. Jake says 2016. I say 2019, 2020.
Because I'm cheap.
I thought we petered out at 2019, 20, but 22, things have skyrocketed, and no one would have known because those experts out there didn't know that the government was going to pump trillions of dollars, didn't know that there's going to be no supply of single family homes, didn't know that all of a sudden demographics have shifted and people are renting more, didn't know that money for the rest of the countries are flowing back into the United States and it's chasing yield, didn't know that the stock market sucks and it's a Ponzi scheme, didn't know that crypto is an asset that's just trading and there's so much volatility. So they're looking for more stability. That's why multifamily is really hot right now. So in this part of the market cycle, what we're looking for is assets that are newer. We're buying older assets. Talk about
some of the deals that we're actually buying.
Exactly.
Dive into some of them.
Yeah. So exactly. So some of the assets that we're buying are older assets, but we are buying them right, getting into them for $65,000 to $70,000 per unit, adding another $10,000 per unit in CapEx. We're at, let's say, an $80,000 per unit cost basis. But this asset, once it's repositioned, it's worth $125,000 to $130,000 a unit. And when we've repositioned it, the asset is as if it's brand new. We know our budgets, we know our going in cost, we know our after repair value of what the asset is. So we know we're buying it right. The problem is a lot of these older assets, you're not getting into them for 65 or 70,000 a unit. You're getting into them for, 100, 105,000 a door. Then all of a sudden you need to put significant CapEx. And then all of a sudden you're at your cost basis of what the asset's worth. There's risk involved in that because if all of a sudden rents decide to decrease a little bit, you're in trouble. We like assets that are a little bit newer in the 80s, right? We like assets because of plumbing. When you have significant, assets that are significantly older, plumbing becomes an issue. Make sure roofs become an issue. Hot water heaters, AC units, all this stuff is significant capital expenditures. If you're buying them at a good price and you can turn the asset, great, then you go ahead and do it. So for us, we're looking for assets that are a little bit newer. We're looking for assets that are a relatively stable and higher median income. We're looking for median incomes for at least $50,000. The metric is 3 times net income, 3 times gross income for rents. If you're in an area between $30,000 and $35,000 median income, it's a little bit rougher. The tenant base is going to be more difficult. Once again, it's a function of price.
But it tends to align with higher crime too.
Yes, it's a function of price. If you're going to get it for a C property for a really great price, and your strategy is, hey, I'm going to buy this property, renovate it, reposition it, and flip it. I'm not going to hold it out. Bam, that may be the solution there. But Go back to the Jake and Gino show with Dr. Peter Linneman. Dr. Linneman discusses buying in decades. That's what Jake and I are doing. We're buying in decades. We like to hold these deals long term because that's when you get and that's when you receive the major benefits in real estate. In 2013, our first asset we bought, rents were $350 for one bedroom. We still own that asset today, 9 years later. Guess what? Rents are $995 plus rubs. So if you think about the wealth that's been created, the debt is basically the same as it was 8 or 9 years ago. We've refied it once. We've put a little more debt on there, but the net income is exploded on that property where principal is being paid down by the residents. We're getting appreciation. We have tax benefits from that one asset. Holding it for the longer term has created so much wealth. So what I want you all to do as you're listening to this, figure out what your buy right criteria is. Figure out what it is. Do you want to syndicate deals? Do you want to JV on deals? Do you want to use creative financing on deals? I'd say yes to all of those. Figure out where your market is because all different parts of markets in the United States are in different parts of the market cycle. Some may be in recessions, some may be expansion, some may be in hyper supply. Understand where that is. Look at pricing, figure out what pricing is, and then ultimately figure out what your exit strategy is. Some of you out there may want to buy these assets, hold on to them for 2 or 3 years. If you're syndicating, then flip out and profit on them. Great. Understand what that strategy is and figure out and put it into your buy right criteria and then start looking at assets, number of assets you can buy, unit mixes. Are they garden style apartments? Are they townhomes? Are they built to rent model? Whatever that looks like, you need to be crystal clear on it, formulate the plan, and then make sure it works in that part of in your market where you're investing in. It's really, really important. Figure out what your buy right criteria is.
Okay, so we have a 1980s build and that we're working on right now. It's a complete renovation, a complete gut. And then we have another one that's a 1970s, but it was better. It was more well-maintained. And that's a light reno. Everything else that we're buying, because these take up resources we internally manage, is 2014. We have another 2008. And then we have a 2000, which will be essentially light upgraded turns. So there's no bandwidth taken off the team. And we're buying land right now because we've been working for the last few years on the development. So basically we've shifted to smaller mom and pop deals. Those range from 20 to 100 units. This doesn't mean that we won't take on a larger property. We just haven't seen the value recently. Even though we're underwriting these, we're putting in bids, we've come close a bunch of times. We just haven't closed any yet. So close but no cigar. All our recent deals have been done with in-house capital, no syndications. And the land, we touched on the land over the past 2 years, been working very hard in development. We're now sitting on over 120 acres, so very proud about that. And what I like to call climbing the ladder. It's crucial. Again, I said this in the opening. It's crucial that you know your rental comps because we're having a hard time finding cash on cash from day one. So what does climbing the ladder look like? Gino touched on a little bit. Maybe you get into a deal for $80K per door and the rental rates are $600. You know that doesn't work really well. But the reposition rental rate is $900 to $1,000. So you got to climb that ladder. You're not going to get there from day one. It's going to be a year to get that property to where it needs to be. But it keeps the snowball rolling. It's cash flow, out in the future. You're able to cruise past the 1% rule while climbing the ladder, but it's hard to buy on actuals or cash on cash from day one in this environment. I say it all the time. We're buying boxes. What do I mean by that? We're looking for newer product. We love townhomes. We love quality construction, ability for washer dryer hookups if they don't exist. And to Gino's point earlier, in an area where there's median income and population growth. So, GDAD. That's a little bit about what we're doing, right? We're making it happen. We're out there kicking down doors, finding value where we can. And hold up the book again because you're giving it away if someone emails you at Jake and Gino. There it is. Creative
Gino
cash.
at jakeandgino.com. And let me recap one thing Jake said, which is really important. You're buying on a pro forma. Create your own pro forma. You're not buying on the broker's pro forma. You're not buying
don't
on
pencil whip
pro
it.
forma. You're
Don't
buying
pencil whip it.
on your pro forma. And that's what you're doing in this part of the cycle. And you know what? 6 months from now, things may change. That's why you need to keep coming back, listen to these how-to videos, listen to the Jake and Gino show, because we're always on top of the market. We're vertically integrated. So we're doing this business every day and we're seeing those trends. And then as top of that, our Jake and Gino community, they're investing in these deals as well. So every time we have a boot camp, we have a money mixer, we have some type of on-site intensive, we're sharing this information with our students and our students are sharing it with us and they're talking about what's happening in their market. So we're on top of this and we're seeing what's going on. And the person who is able to pivot in the market cycle is the person who's going to start taking these deals down. The last thing, Jake, quickness. We had a student who lost a 25 unit deal the other day is because they took time putting in an LOI. This part of the cycle, quickness is key. Don't hesitate. He who hesitates will be eaten alive. You need to really have a lot of speed and decisiveness in this market.
Yeah, and I just want to close it out with saying being flexible. These are not huge pivots. We're still buying apartments. We're just finding ways to pivot, make the deals work. We may go up to buy larger stuff. We may go down to buy mid-sized stuff. We may use different tools. May buy internally with joint ventures. May do a syndication if a huge monster deal comes along. We're just threading the needle and doing what makes sense. And as we always say, the John Madden quote, we're taking what the defense gives us. So, Gino, great stuff. Thank you so much, and we'll see you next time.
Thanks, Jake.